Hey everyone, welcome back to the channel. Investing is one of the best ways to build wealth, but let's be honest, it's easy to make mistakes, especially when you're just starting out. In today's video, I'll cover the top 5 mistakes new investors make, and more importantly, how to avoid them. We're going to break down each mistake, understand why they can seriously hurt your portfolio, and then I'll give you actionable steps to avoid them completely. By the end, you'll have a better understanding of how to approach investing with confidence and avoid costly errors. Let's get started. The first mistake is jumping into investing without a clear plan. Many new investors dive in without knowing their goals, risk tolerance, or time horizon. It's like setting sail without a destination or a map. You might end up somewhere, but it's unlikely to be where you want to be. Think of it this way: if you were building a house, would you just start laying bricks without a blueprint? Of course not. You'd need a detailed plan that outlines the size, layout, and materials needed. Investing is no different. You need to define your financial goals. Are you saving for retirement? A down payment on a house? Your kid's college fund? Once you know your goals, you can determine your time, horizon, how long you have to invest. Next, you need to understand your risk tolerance. Are you comfortable with the ups and downs of the stock market, or do you prefer more stable investments? Your risk tolerance will determine the types of investments that are right for you. Finally, create a written investment plan. This document should outline your goals, time horizon, risk tolerance, and your chosen investment strategy. Having a plan keeps you grounded, especially when the market gets volatile. It prevents emotional decisions and keeps you focused on your long-term goals. Next up is chasing hot stocks. We've all heard about the latest stock that's skyrocketing, and it's tempting to jump on the bandwagon hoping to get rich quick. But investing based on hype is a recipe for disaster. Remember GameStop? Or how about AMC? These stocks saw their prices skyrocket, driven by social media frenzy and FOMO, or the fear of missing out. New investors, lured by the promise of quick profits, poured their money in, only to see those gains evaporate just as quickly. The problem with chasing hot stocks is that you're buying high and often end up selling low. By the time you hear about a stock on social media or from your friend, it's likely that institutional investors and algorithms have already priced in any potential gains. Instead of chasing the next hot stock, focus on long-term investments in companies with solid fundamentals. Look for businesses with a strong track record of profitability, a competitive advantage, and a competent management team. Remember, investing is a marathon, not a sprint. Slow and steady wins the race. The third mistake is putting all your eggs in one basket. Maybe you love a certain company or sector, but over-concentrating your portfolio is risky. Diversification is key to managing risk and protecting your investments. It's about not putting all your eggs in one basket. So even if one investment performs poorly, the others can cushion the blow. Imagine you invested your entire life savings in a single company, and that company suddenly went bankrupt. You would lose everything. That's why it's crucial to diversify your investments across different asset classes, such as stocks, bonds, and real estate. Within each asset class, you can diversify further. For example, within stocks, you can diversify by sector, market capitalization, and geography. This means investing in a mix of large cap, mid cap, and small cap stocks, as well as companies in different industries and countries. Think of it like this: a balanced breakfast is healthier than just eating donuts, right? The same goes for your portfolio. A well-diversified portfolio might not be as exciting as owning a single hot stock, but it will be much more resilient and help you sleep better at night knowing that your investments are protected. Mistake number 4 is trying to time the market. Many new investors think they can predict when to buy low and sell high, but even experts struggle to get it right consistently. It's like trying to catch lightning in a bottle. It's incredibly difficult and often leads to more losses than gains. The stock market is influenced by a myriad of factors, from economic data and geopolitical events to investor sentiment, and even plain old luck. Trying to perfectly time your entry and exit points is nearly impossible, even for seasoned professionals. Instead of trying to time the market, focus on what you can control. Time in the market. The longer you stay invested, the more time your investments have to grow and compound. Remember, compounding is like magic, but it takes time to work its wonders. A much more effective strategy is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the market's movements. By investing consistently, you buy more shares when prices are low, and fewer shares when prices are high, averaging out your cost basis over time. The final mistake is ignoring fees and costs. High fees can eat away at your returns over time, and many new investors overlook this important detail. Just like those pesky ATM fees that slowly drain your bank account, investment fees can silently erode your wealth over the long run. There are several types of fees to be aware of, including expense ratios charged by mutual funds and exchange-traded funds, ETFs, trading commissions, and advisory fees. Every dollar you pay in fees is a dollar that isn't working for you in the market. The good news is that there are plenty of low-cost investment options available, such as index funds and ETFs. Index funds in particular are a great choice for new investors because they offer broad market exposure at a very low cost. Make sure you understand the fee structure of any investment before you buy it. Read the prospectus carefully and compare expense ratios. A small difference in fees can make a big difference in your returns over the long term. Alright, let's recap the top 5 mistakes new investors make and how to avoid them. 1. Not having a clear plan. Define your goals and strategy. 2. Chasing hot stocks. Focus on long-term investments. 3. Ignoring diversification. Spread your risk across different assets. 4. Timing the market. Consistency is key. 5. Ignoring fees and costs. Choose low-cost options to maximize returns. By avoiding these common mistakes, you'll set yourself up for success and make smarter investment decisions from the start. Thanks for watching. If you found this video helpful, please give it a thumbs up and subscribe for more investing tips. Have you made any of these mistakes before? Let me know in the comments. I'd love to hear your stories and how you've learned from them. Until next time, happy investing.